You're now live.
We are now live and we're back. And we are going to take our first look at S-253. Actually, we had Ledge Council walk us through this last week, and then we thought we'd have Senator Rahm, who's one of the sponsors, just fill us in. We're still trying to get the treasurer's office. I don't know what all these meetings are. People are tied up all day, but as soon as we can get someone from the treasurer's office, if they come over and give us a stamp of approval, I'm thinking we might vote this one out, but it won't be the first time I find out there's a problem. So Senator Rahm Hinsdale, why don't you tell us what the story is behind this bill?
Thank you, Madam Chair. And I thought I would either be coming in to help you determine if you would vote it out or move it to another committee. It feels like a pretty technical bill, and I hope you simply vote it out. I just talked to my chair, Jeanette White, who said, hopefully they keep it and deal with it because it sounds pretty technical. But yes, indeed, as you may have heard from Legislative Counsel, this feels like it's related to outdated language about the kinds of financial instruments that an endowed cemetery needs to be invested in under our current statute. So this originally came to me from a couple who are involved in Morningside Cemetery in Charlotte. It's a small endowed cemetery that runs as an exempt business. They try to make it very affordable for anyone in Charlotte to be buried in this particular cemetery. As an aside, the botanist Cyrus Pringle is buried there. He's a very famous botanist in Vermont's history. My husband's family actually has his farm where a lot of his trees are planted now. So it's a small but meaningful cemetery to folks in Chittenden County. They went to the folks involved in the cemetery went to invest their small endowment with Hansen and Doremus, a national firm that went and looked at our requirements for an endowment like that. And I'm pulling up, they found 3 flaws, and I'm happy to send you the memo that I would consider a public document at this point. It's a memo from the firm that says there are 3 major flaws. The existing regulations have been in effect 42 years. They are outdated and inoperable. Savings and loan associations, both state and federal, do not exist anymore as financial institutions distinct from commercial banks. FIREA, F-I-R-R-E-A, which was enacted in the late 1980s, erased their unique features. The Federal Savings and Loan Insurance Corporation, which the law says must insure federal S&Ls in which investments are made, ceased to exist more than 30 years ago. Banking and investment tools and strategies have evolved dramatically. For example, mutual funds are not eligible investments under this state law. So really, this firm wants to follow the letter of the law, and there are elements that are outdated that have evolved significantly and really make it hard for them to follow our law and do what they naturally do as a pretty well-established financial institution.
Okay. So if you send that to us, we will forward it over to the treasurer's office for comment. I understand that we allowed town cemeteries a broader width a year or 2 ago, and that these endowed or for-profit cemeteries are the ones that we've still got holds on. And yeah, it sounds, all I can think of is It's a Wonderful Life when we start talking about savings and loans and
right. Yeah,
the banking world and the insurance on banking and on savings has come a long way. So we'll get that over to them and hopefully we can get it out. Committee, any questions?
I just don't know who's going to play Mr.
Senator
Potter.
Peters,
Well, I just, you reminded me, or I was thinking we did this already, but I guess there was some pieces that we missed. Is that what we're understanding?
it sounds like it, yeah. Apparently Probably the
Yeah.
League of Cities and Towns asked us to do towns. And we
Right.
missed everybody else. And this may have gone through GovOps. I don't
That's-
remember doing this.
Oh, maybe it was my time on GovOps. We did it around something to do with cemeteries because I remember Senator Clarkson's unforgettable testimony, but I guess maybe not privately held cemeteries. Is that what maybe the distinction? Anyway, thanks for helping us correct this.
Yeah, we did some really informal due diligence on that in Senate GovOps when I said I'm coming over here, and they might just want to move the bill to GovOps, and they thought they had done the same thing. But when I mentioned that it's this small endowed business exempt cemetery, they said it sounds like we just didn't align the language and clean it up for those small cemeteries as well.
Okay, and we'll ask Trevor to make sure that we use the same language wherever possible. I can see where the state has, having been through something where perpetual care funds were not in a trust and went away, that the state has an interest then when you invest in what you think is going to, either have your grave or the grave of a loved one cared for at least as long as you can imagine, that money is managed as well as humanly possible.
Mm-hmm.
And so we will, but also, I don't see why there's a difference between an endowed, a town, or private or for-profit cemetery. These protections should be the same. So maybe
that gave me, oh, sorry.
No, go ahead.
One last thing is that, just to underscore that, this really was a couple that are trying to do as much due diligence to make sure the endowment is secure and strong. And they did share this desired change with the Vermont Cemetery Association. And I do have an exchange from last fall where the Vermont Cemetery Association felt comfortable with this. I don't want to put words in anybody's mouth here, but this particular oversight group did a lot of due diligence for a small community cemetery to try and do this.
And we probably should hear, if you have some contact information, if
Yeah.
you can send that to Faith, we'll at least ask if the Cemetery Association would like to speak on this issue.
Absolutely. I'll dig that out.
It's easier to do now with Zoom.
Right. Yes.
They don't have to trot up to Montpelier, but my thing on my computer says it's 20 degrees in Montpelier now. So it was -1 at noon. Things are changing rapidly, or all the computerized things aren't synced. Okay. So any questions right now? Okay, thank you.
Thank you. I think this could be a win for your committee, and I appreciate you
Oh,
taking it.
We need a win.
Yeah.
Senator
All right.
Ram Himstead, where is that cemetery? Charlotte? But where?
Yeah, it's in Charlotte, right off Spear Street. It's actually, so my husband's family farm is at Spear and Prindle Road because Cyrus Pringle's original last name was Prindle. And across the way, near that intersection, is this cemetery off Spear Street.
Okay, thanks.
Little bit of history of Charlotte for you.
Yeah. Okay. I saw, Sarah Clark is here. So we're a little ahead, but not too bad. Sarah's going to walk us through again as we look at tax codes and looking at tax exemptions and all the tax credits that have been proposed to us. We also have the revenue forecast, which is really good for this year and next year. And then kind of goes back to where it's been historically. And I've asked Sarah to come in, and so give us kind of what the history's been and once we return to normal, what do we think it's going to be?
Great. Well, good afternoon. My name, and I do have a presentation to share, but before I do that, why don't I introduce myself? Because I think this is my first time in this committee.
Is it really?
It's been a number of years.
Apologize.
Oh,
yeah,
gosh,
I see
no
you
worries.
on so many other committees.
You do for sure. So my name's Sarah Clark, and I am the Deputy Fiscal Officer at the Joint Fiscal Office. I actually started in this position back at the end of November. A lot of your faces are familiar to me. I most recently was the CFO at the Agency of Human Services for about 7 years and have worked in a variety of financial roles in state government over the last 18 years. So I'm really excited to have joined the Joint Fiscal Office and pleased to be with your committee today.
Good. And do you know the members of the committee? We can all introduce ourselves.
I do. I may not have met a lot of you, but I definitely have seen a lot of you at the State House, and your faces are all recognizable to me. So
okay, the mug shots hold. All right.
Great. Well, with that, why don't I go ahead and share my screen? Just give me a minute to get oriented.
Okay, and committee, your faces are all going away, so you're going to have to holler if you have a question.
Can you see my screen?
Perfectly.
Great. Okay. Okay, great.
There's the alligator.
There's the alligator. And I'm glad that you referred to it as that. So this is what I would call an updated alligator chart. It may look a little bit different than the last time you saw it. One of the reasons for that is that the scale on the left axis has been adjusted to start at 0. As such, the gaps may appear smaller because the scale is larger. And so things are kind of evened out because of the adjustment in the scale. However, the slide that we'll go through next, you'll be able to see some more of that detail and a wider opening of the alligator mouth, if you will. It's important to understand that the projections included in this presentation are estimates and therefore subject to change.
Mm-hmm.
This chart reflects general fund revenues over time. That's the blue line that you see. Those general fund revenues include direct apps and reversions. It also, the green line, includes the baseline appropriations over time. Data from FY16 to FY21 reflects the actual revenue and expenditures in that year, essentially information that was pulled from the operating statements after the year had closed. The revenue projections for 22, 23, and beyond reflect what was just approved by the Emergency Board in January of 2022, with some assumptions for direct apps and reversions in the future. Very level assumptions. It's important.
I'm sorry, but you've said this a couple of times. Direct apps, I think you said.
Yes.
Are we talking about cell phone apps, or what kind of apps do you mean?
Thank you for asking the question. When I say direct apps, sometimes in state government, as part of the revenue picture, we will look at balances in special funds, for example. And if it's determined that there is a balance that's available to be used as a revenue source into the general fund, there's a mechanism by which that gets worked into the budget process. So it's a direct app. I think it does refer to application, though I've never kind of seen it spelled out. It's always been just referred to as a direct app. And maybe I'll also pause based on that question to a reversion is when there was a general fund appropriation in a prior year that may be determined to no longer be needed. And so those general funds will revert back as a source of revenue into the future.
Thank you. Appreciate it.
Yeah, thank you for the clarifying question. As you're aware, in recent years, the one-time appropriations have been unprecedented. As such, we have excluded them from the baseline appropriation. So you're just looking at our assumptions for what's kind of ongoing base appropriations to support state government. For state fiscal year 22, we are looking at the recently passed budget adjustment by the House. As you know, the Senate Appropriations Committee is doing their work on budget adjustment right now. For state fiscal year 23, we're reflecting our best estimate of a steady state budget while accommodating some unknowns that may impact FY23 appropriations. When I gave the caveat early on that this is subject to change, this is one of the primary areas that we know will change over the coming months. And we're going to discuss that in a little bit more detail on the next slide. Our projections assume that baseline appropriations grow at 3.5% in state fiscal year 24, 25, and 26. And that's what's projected here. The COVID-19 pandemic created very unusual circumstances in FY21, which is evidenced by the large gap between revenue and base appropriations. In 21, there was more revenue available than there were baseline appropriations. We use that revenue for some one-time investments that we'll talk about a bit more on the next slide. As we look to the future in FY24 and beyond, at 3.5% growth on the base of spending, our spending stays roughly in balance with the current projected revenue forecast that is anticipated to grow at 1.2%, 2%, and 2.4% respectively from FY24 and beyond. Though it'll be tight in those years, there is not a significant gap projected. However, if any of those projections differ from these assumptions, that outlook could change. So with that said, I'm going to move to the next slide, which really is going to drill into more detail to the box. And you'll probably start to see an alligator mouth similar to what you would have expected to see in years prior. So as I said, this is a zoomed in version of the box on the prior side. The scale is no longer set to 0, which allows us to see those bigger gaps between spending and revenue. It is a smaller mouthed alligator than you may have recalled as seeing historically. But as I said, there are still a lot of unknowns, and it can be challenging to project what will happen specifically. To orient you to the slide again, the solid blue line is the general fund revenue from the January 22 e-board forecast, including the direct apps and reversions that we discussed previously. The solid green line again reflects the baseline appropriations with the one-time funds removed. Now, the dotted green line that you see right here, and can you see my cursor when I move over the picture?
Yes.
Are you able to see that?
Yeah.
Good. Okay.
Yeah.
The dotted green line reflects the baseline appropriations with the one-times added back in. So you can see the significant jump up in spending from the solid line to the dotted line when we account for the one-time appropriations. The the dashed blue line is a revenue line if we were to make policy changes that netted to a reduction of $50 million. This amount at this point is just for illustrative purposes. Though in the governor recommend budget, if you recall and are probably aware, he did propose roughly $49.5 million of tax and revenue proposals that would impact the general fund. Did I see a hand up?
Anyone? I don't think so.
Okay, great.
I can't
Okay.
see anyone, so they really need to holler.
Okay, great. So as I said on the previous slide, FY21 was a very unusual year where we had roughly $500 million more in revenue than baseline appropriations. And you can see that big gap here with the kind of revenue up top and the baseline appropriations down below. We took that $500 million of one-time funds and spent it in a variety of ways, including setting aside $150 million as a pension reserve, allowing for $100 million general fund to state fiscal recovery fund swap as part of the closeout construct at the end of the year. $52.4 million was set aside for state employee OPEB, and almost $50 million was added to the rainy day fund. So we use those $500 million in a very kind of strategic manner for some one-time investments. In FY22, if you focus on removing or adding back in the one-time appropriations, and you focus on the gap here between revenue and expenditures, you'll see that it's more narrow than it was down below. And the difference is roughly $85 million. The House used that $85 million to set it aside in their budget adjustment as a reserve for future needs for state matching funds for things like the Infrastructure Improvement and Jobs Act, IIJA, which is going to have great impact on our transportation spending and will require a state match. And so the House was working to plan for those additional match needs by setting aside this $85 million reserve. However, in the budget that the governor presented last week, he has fully expended any sort of general fund balances in the FY23 budget. Moving into FY23, there are still unknowns from an appropriations perspective, but this reflects what our best estimate of a steady state budget will look like, with some key areas of potential spending. However, it's still in flux and our conversations are in the early stages. Our capacity for spending in FY23 will be impacted by the interplay of the American Rescue Plan Act state fiscal recovery fund dollars. If you recall, last year, the legislature set intentions for more than $1 billion worth of spending for state fiscal recovery fund dollars. As we look to the future, state fiscal year 24, 25, and 26, if we proceed with the $50 million lower revenue because of various policy proposals, there is a baseline budget gap that exists in 24 and grows in the out years. This will ensure that we'll need to have ongoing discussions on budget reduction to revenue increases to come into balance annually. So as I kind of draw my cursor around this section of the graph right here, that is the alligator mouth opening that we have discussed in the past, or at least my prior colleagues did at the Joint Fiscal Office with you. And with that, I can pause for questions.
Okay, committee.
Madam Chair?
Yes, Senator Bray.
Thank you. Ms. Clark, thanks so much. This is a really helpful view of what's going on. I have a couple of questions. So is the alligator's mouth that's starting to reopen, is it in essence, well, not only because, but in part because of returning $49 million in revenue back to Vermonters, reducing taxes? Otherwise, would that close the gap at the outset?
Yeah, I think that the gap would be much smaller if we didn't move forward with a tax spending proposal. The gap would be relatively imbalanced, as we are estimating right now, between revenue and expenditures. There's a lot of unknown. We are assuming appropriations grow at 3.5%. That could change, and that would affect the size of the mouth.
Sure.
Yeah.
The other thing you had mentioned, the unprecedented amount of money we have, how we've done swaps and applied funds to things like OPEB and pension, et cetera. So I don't envision that we'll ever see the left-hand side of this chart again in our lifetime. I'm trying to figure out, are those, have we dealt with those in a permanent enough way, OPEB, for instance, and pension, that we're not on course to see another, I don't know if it's the alligator, because maybe we track it separately, but are we going to end up with a gap again on those long-term commitments?
No, my belief, having worked in state budgeting for many years, is that there's likely in the future going to persist with this gap between available revenue and expenditures. I do think that some recent activities from the pension task force and by the legislature on the specific issue that you referenced, I do think that there is a path forward, a trajectory to try to minimize the impact of that on our future gaps, if those proposals were to proceed.
Sarah, just for clarity, this graph assumes that we do all the tax cuts that were in the governor's budget, or it's based on the governor's budget?
So there's two different scenarios on this chart here.
Okay.
If it, and I want to just caveat, so it's this dotted blue line right here
Yeah.
that is really just assuming a $50 million proposal related to tax.
Okay.
You know, the governor's was 49.5 million, but it's really for illustrative purposes only. So you can see if you proceed in that manner, there will be the gap between the green line and the dotted blue line that I'm
Much
hovering over here.
Sooner
Yep.
than, yeah. Okay.
Correct.
They are crossing there, but staying fairly close. But if we give away or give back 50, 49, 50, this market, it's like, what's $1 million? If we give it back, then we have a much wider gap. And okay. And continuing to grow wider.
Correct.
Okay. All right.
Is it helpful if I stop sharing my screen, or you?
Yeah, the committee, have you gotten enough of the screen to feel you can ask questions without it? I'm not hearing anyone scream, so take the screen down. All right.
I did provide, though admittedly a little bit late, I did provide the documents to Faith, so you can have
Okay,
a
so
closer look
They
at
are
them.
up on our.
Yeah. Yep.
I'll find them up here. Yeah.
Do we have a name for the left-hand side of the chart? I mean, we have the alligator's mouth. I don't know if it's alligator's a belly, the surplus.
I think
Christmas.
we could brand something.
Right, there's a chance.
Okay. So the basic message is we've had a couple of unexpectedly really good years, despite a national pandemic, loss of jobs, continued loss of jobs. But that vacation is ending and we are back to our really tight revenue and approps, and the pressure is for that gap to grow. A large part of it is personnel costs, right? And debt service is pretty fixed as long as we don't run out and do stuff. But personnel costs, and part of that is pensions, does go up. Okay.
That's correct.
Committee questions? None? All right, so, and if we do all the tax cuts, we have that wider gap. So we're starting out, and this does not presume any new programs or major increases. This presumes the governor's budget for spending.
It assumes, yes, basically current services level of spending with a few caveats. And I think, you know, the size of the gap really can change based on the levers that we pull, both from an expenditure and a revenue perspective.
Because I don't believe there's been anything proposed for the mental health system or any major influx. And I'm assuming education is probably hearing a lot of what health and welfare is that the schools really need help. And a lot of it is just the counseling. So Senator Bray, your hand is up.
Yes, ma'am. Thank you, Madam Chair. The question I have for Ms. Clark is about that baseline. So the 3.5% that you're illustrating, that's based on historical trends for how long a period?
So we actually, the historical trend right now, like using most recent history, is a little challenging because we've seen kind of unprecedented growth in our general fund revenue. And so the 3.5% is in line with what we've used historically, which was around 3% is what we had projected, probably in the last version of the Alligator chart that you saw before the pandemic kind of threw everything up in the air. And so it is in line with what we've seen historically, with a little kind of bump up for what we think is a realistic projection for how appropriations will grow in the future.
Okay. And we also, I know most of us in our recent adult lifetimes haven't dealt with much of in the way of inflation. It's been negligible, but now we're seeing this surge. So how did you and your colleagues treat that and the specter of increased inflation for who knows how long?
I think it's a great point that you're making, and another area of uncertainty that we should all consider as we make decisions in the future. Don't think we specifically accounted for inflationary pressures in this analysis, the impact of inflation on this analysis, but I think it's something we should take into consideration in the future.
Okay, well, thanks. I mean, I can imagine Pay Act, for instance, if inflation really is at a significant enough rate for several years, there'll be more Pay Act pressure, and I'm sure it will flow through in other ways too, but.
Yeah,
okay.
and speaking of inflation, and Pay Act, the state's facing the same workforce challenges that many other sectors are. And so I think that when the details of what's been negotiated as part of the collective bargaining agreement for increase to state employees, it'll be bigger than what we have historically seen, because that's what the market is calling for.
Okay, thank you.
The other thing I don't think is figured in here is part of the Economist report is that, and it was announced yesterday, the Federal Reserve is going to raise interest rates as soon as March and could raise it 2 or 3 more times. And the economists say if they get it right, it'll work. But history says they frequently don't get it right. And we get either, we could get a major recession as we did earlier in the century, or we could just get a little market correction recession. But there's a lot out there. History just says this boom won't continue indefinitely. Because we did take a huge step in revenue, and without any, major growth in business or job, that the revenue is projected to stay up, which is interesting because it's not following major economic activity. It's following a lot of businesses were shut down and are still only partially functioning. A lot of people are still not working at their old jobs, and I don't know that we know where they're gone. So, but the projection is that we took this big jump and we're going to stay there. And that will be interesting to see if that holds out and for how long. Senator Bray.
Yeah, so thanks for that last extra note. It's like, what
I don't want you to go home feeling good.
Who knows what's holding that ceiling up for us at the moment? Because the normal cause and effect things that we've kind of trained up on aren't necessarily working in the same way anymore. So.
Yeah, and then there's a little potential for war.
Any other good news?
I'm starting to ration my watching the news. It's depressing. The only good news will be if our COVID numbers continue to stay lower than they were a week ago, because this is the end of the week and this is when they usually shoot up. But there hasn't been a lot of good news lately. So, okay. Any other questions? Any more information you would like?
Just, I think, leave you on the note that these, based on your comments, these really are unprecedented times. This reflects kind of our best estimate and projection of where we think we're going to go. But who would have thought we'd be where we are right now? So
Who would have thought this morning when they said, well, it'll cost $2 million to do something, and you find yourself saying, oh, just $2 million, it's like that used to be a major catastrophe. And we've been dealing in hundreds of millions and billions for 2 years, and that I've never done that. I mean, it is unprecedented. And so we need to, I think the word is, don't spend it yet and be cautious. Because the chances are it's not going to keep getting better or a lot better. It's returning to our normal growth cycle, which probably should be expected. All right, any other questions? Senator Sirotkin, you look puzzled.
I have a question, Madam Chair.
Okay, there you, yes, Senator Pearson.
Thank you. Would we predict that the infrastructure bill will have will certainly have some impact, we would assume, on 22's revenue? 23, I guess, is fiscal 23's revenue, right? I mean, in a positive way. Usually those kinds of brick and mortar investments are pretty significant, if memory serves.
do you mean from a perspective of revenue generation because of the kind of the contracts that will be executed and the work be performed?
Yeah, exactly. Yeah. It's not as if the federal spending is immediately shrinking. It's, in fact, the bulk of it probably has yet to be spent, and the infrastructure is another significant chunk. So yes, I do. The reverberation in the Vermont economy from those investments, I've got to believe that's not insignificant for the couple of years ahead.
Yeah, no, I think you make a good point. I do believe that the economists, when they do their projections for revenue, they do try to take into account some of these major pieces of federal spending. Because I know one of the things that changed from the July to the January forecast is when the Build Back Better bill kind of came to a stop, and so that made had a negative impact on our revenue forecast. But I think you raised an excellent point, Senator Pearson, about the impact of the IIJA on our future general fund revenues.
We can check with Tom Cavett, but I have a feeling that may be why we aren't dropping significantly, because that economic activity will bring jobs and income tax and should keep our revenues up. If they build houses, we'll get some property transfer tax, but yeah.
And could you remind us how much of the majority of ARPA dollars have not gone out yet, right?
I think if you're focusing specifically on the state and local fiscal recovery funds, which is that $1.25 billion, and you're correct. Though, the legislature has appropriated, let's say, roughly half of them. But I think from an expenditure perspective, most of them have not yet been spent.
So I guess what my point is, I don't think we're looking at any kind of near-term downward plummet that we probably have. It seems reasonable to me to think another pretty solid 3 years ahead, if only based on that economic stimulus. Is that, and I don't have the chart in front of me anymore, but I think we need to be sensible and we need to recognize the reality, but I don't think we need to pretend that we're about to hit a downturn either, right?
Yeah, I think what I would do is and I've written a note to myself, I want to follow up with the economist, Tom Cavett, to just get clarity on how he would have incorporated those factors into his projections, but you're raising excellent points. I agree.
So that would be a question.
Thanks.
If we have unexpended funds, because I know we had tried to budget everything or set money aside for specific purposes. And almost all of those funds had strings attached to them. But some of it was used to free up. So it'd be a good one. Senator Sirotkin.
Thank you, Sarah. Are there time limitations on the infrastructure money similar to what was with ARPA as to when they have to be obligated by?
Yes, there are time limitations on those funds as well. I don't know them for the IIJA off the top of my head, but for the state, for ARPA, state and local fiscal recovery funds have to be obligated by December 31st of 2024 and spent by December 31st of 2026.
Thank you.
I think that the IIJA funds have a longer life than that. My understanding, like the way that federal transportation funds flow, it tends to have a longer life, but I can follow up with the committee on the specific timeline for IIJA funds.
Thank you.
Okay. Any other questions, committee? All right, I'm not seeing any. Thank you, Sarah. I think that makes us clear as we possibly can be, understanding that all things are just our best projections given this moment in time. 2 years ago, we were doing budgets and projections and never anticipated a pandemic. 3 months or 4 months after that, we were looking at $150 million deficit in the ed fund. And this year we're looking at $100 million surplus. So this has been a roller coaster, and and I think the economists tend, as they should, to be somewhat conservative. It's easier to say, gee, you've got more revenue than we thought you would have, than it is to say, whoops, you're, over budget and you've got to cut it back. So I think this is just good information to have. Okay.
Well, it's
All
my
right.
pleasure being with you today. Nice to
you.
see all of you.
All right. Thank you, everybody. Whoa, we are running ahead here.
Senator Cummings,
Yes.
this is Faith. I've talked to Chuck Storrow. He can't come in right now, so I thought maybe you could switch Chuck with the committee discussion at the end of the day.
Yes, that would be good. We're playing, for anyone that doesn't know, Dylan's grandmother passed away, so he can't be with us today. And Chuck was going to fill in. We were just going to give him a chance to respond to the feeling yesterday that we're going to let the Rygate bill that we did last year ride for another year, and they could come in and make a progress report to us at that point. I'm assuming if there's some great change that they can, they can always come in before crossover. They can probably find a House bill. There's a number of energy bills kicking around if something changes, but it seems like we're at impasse. And I just, I don't want to spend time. We've got a couple of those bills that we may be at impasse, and I'm just trying to get some things, decided. Is it worth going forward with this one or not? Or see where it goes. So we're giving Chuck or Dylan weren't with us yesterday. And I guess I always assume Dylan's watching because he always has been, but he may not have been yesterday. Other than that, bills in committee, what I've got is the S-269, which is the pilot, the 3-year pilot with the energy savings accounts. Those stakeholders asked to have a chance to go to the hall and see if they can work something out. So I'm going, give them a couple weeks to do that. Hopefully they can. And I don't know how many of you were with us, but one of the big balancing points was one, the business that brought it to us first has 250, Senator Brock? Or is it only 150 union jobs in the Northeast Kingdom? It's a lot of jobs in the
lot of jobs. Well, I mean, you're talking about the bill that we discussed yesterday.
Yeah.
There are 150 jobs in Franklin County alone.
And
jobs at West Rock are there are 150 well-paying jobs there.
And they recycle cardboard, right? And they
produce cardboard.
Yeah.
And they have, I don't know, something like 8 plants. And this is by far the most expensive plant that they have in their system in terms of energy consumption. And why this bill was so very important to them is that it allowed them both to get more value out of changes they make in their electricity usage, but also in their thermal usage. And it could take it from the most expensive to one of the lesser expensive, and therefore give much greater assurance that those jobs are going to stay.
And they're here because they want to be near the Canadian market. And we know that New York offers much lower rates in commercial electricity. So that was we can retake that testimony, but we didn't get that testimony yesterday. I'm sure Senator Sears will have Mac Molding in. They were another one of the companies. Again, Bennington County is not the most prosperous county at the moment, and Mac Molding is probably one of, if not the biggest employer down there. So
this West Rock in Franklin County the process they use is very energy intensive, but they pay, I believe, about $350,000 a year to Efficiency Vermont. So it's significant, and
we're letting them reinvest that in their plant. Okay.
Yeah, reinvest it into things that are energy will meet the same kinds of objectives that Efficiency Vermont is trying to achieve.
Okay, so I have Senator Bray and then Senator Pearson, and then I will get to Senator McDonald. Okay, Senator Bray.
So I think everyone in here wants to see employment and good jobs, and I think I think that's a given. What I would like to learn more about, so that we can be even-handed about this, is in what way are people allowed to use energy efficiency dollars for their own benefit or in order to reduce the cost of electricity to everyone who's part of the system. And just as you or I couldn't appeal to Efficiency Vermont and say, let me retain my dollars because I'm going to do something else here. I'm going to get a better heater. And that might not be what they could support because I'm using a gas heater or whatever. The other thing is, I don't honestly, it's too bad to hear that they have unusually high, that it's an unusually inefficient plant, because I know that
it's not.
We've also heard stories like Husky that's participated with Efficiency Vermont in doing efficiency work. And now they are the site to visit because they're the most efficient plant in the Husky family. Like other managers come to Vermont to see how they do it because we're doing so well. So I hope we can find something good for everyone to do here.
I think that was the
testimony, as I
goal.
we had the last time, we talked about some of those very issues when we approved this 2 years ago.
Yeah.
So that was the goal. The question is, did we reach it? And it sounds like COVID slowed all of this down too, but we'll make sure that's the case. Senator Pearson.
Thank you, Madam Chair. Sarah Brock, I don't know if it matters, but it would strike me that tier 3, which is an obligation on our electric utilities to help fuel switching, might also be a way for the employer to take advantage of efficiencies that it sees and wants to invest in, and maybe could work out a deal with Swanton Electric or whoever has that account. But more fundamentally to the bill, we've approved a pilot. Some people had misgivings, some people didn't. We don't have results yet, and it's just on its surface absurd to me that we would be asked to extend the pilot when we're in the middle of a pilot and we don't have results yet. And so somebody needs to square that for me, and why we would be in a hurry to prejudge the outcome of this pilot. It just doesn't make any sense. Maybe it's valid, maybe it's terrible, but we've set ourselves up with a whole plan to test that. And we have been told very plainly yesterday that we're not going to have that data in a convenient way to deal with this timeline, right?
Well, we were told when we set it up, the final report is due, did they say, in October? What happened is that COVID, it sounds like, and they're supposed to be checking that. And so some of these points, everything was shut down for a number of months, and then some of them reopened, probably more, some less quickly. Supply chains backed up, all the rest of it. And so we don't have any results to measure because only 4 of the 9 have actually gotten their plants in, and none of them have signed a contract committing the money. So the question was, the PUC has already told them, if you're signed, sealed, and delivered by January 30th, which is the end of the pile, then you can draw down your money. The question is, do we want to give, because then, we might only have 2 or 3 plants in the sample to work from, or do we want to extend this only, and say, okay, those of you that signed up, let us know if any of you want to continue, get, a progress report, and we could ask for that, and let those 9 finish up, and then we would have 9 in the sample, which is better than 2 or 3. Or we can just say, okay, we're going to extend, and extending it at this point. Yeah, we don't have any data to base, and, just opening it up. But it's how do we want to extend it? I suppose we could just say, nope, we're pulling the plug. And if you haven't got, you haven't drawn down the money by June and got it out the door, it's not going to work. But
well, so if you're asking me, I do mean that we don't do anything until we have the data, since we've set up and maybe if the data comes back, then I think we have a different discussion.
Yeah.
And it's not, the pandemic's been tricky, but made everything a little complicated, but it doesn't, I'm not hearing a compelling reason to change the timeline and myself.
Well,
anyway,
because we've only got 4 that have submitted a plan. So what's that, 40%? are we going to have enough data if only 2 or 3 of those folks are able to actually draw down the money by June?
Why do you say draw down the money? It's their money. That's the whole
No,
point.
that's in a fund. They don't control
Right,
it.
right.
They have to put a plan in. It has to be approved. Then when they get the contract signed, they get to draw it out.
I
But
see.
it's not sitting in their account. It's sitting in our account somewhere. So we need, and the question is, how much data will we get? And right now they're all talking, and I'd like to see what they come back with, because this is Efficiency Vermont that asked to do it. And yeah, as we go through,
Well,
to me says, if I can buy down X number of thermal units somewhere, what else would that money, what's our lost opportunity cost by not using that money, putting it into Efficiency Vermont? Will I get how many more checks to buy a high efficiency dryer? Is that what they're going to use it for? Or are they going, it's where are we going to get the most cost benefit? Or benefit? It's an environmental benefit we're looking for. So I'd like to see what they come back with. And we'll see where that goes. Senator Brock, and then Senator McDonald, do you have a question, or you?
I will defer to Senator Brock.
Okay.
I would just suggest that the committee wait to hear testimony on this so that you have a full picture of why we're at the point that we're at right now. At the point that this was approved by us 2 years ago, there wasn't a pandemic. There also was not slowness and delays in receiving material approvals, report findings from the Public Utilities Commission. There was not a major supply chain disruption that occurred throughout numerous industries. So there were a lot of unforeseen circumstances that we weren't aware of at that time. But I think that rather than my attempting to explain it, I think that that it's up to the committee to listen to the testimony and then judge for yourself.
Yeah. And at this point, I intend to give all the interested parties, which Efficiency Vermont, the PUC, I guess they're working with somebody at Community Development, who I'm sure is representing the involved businesses. Let them talk and let them come back to us with a recommendation, and we can make a decision at that point. And we're working through weighting studies. We're going to try and set up a day next week we're going to talk to the school superintendents, the school boards, and I've asked them to see if they could find us some representatives from schools that we think might be winners or losers. The schools probably know. So, and I'm just trying to get a perspective on their take on the equity grants for equity payments versus weighting. Also some sense of what the schools can handle right now. I'm sure the schools that are going to make money would like us to do it yesterday, and the schools that are going to lose money would like us not to do it at all. But schools are under stress, and so I don't want to be any more disruptive than we have to, but basically ask them to come in and just give us their perspective. We've had Professor Colby. I'm trying to, I think we've Faith and I went through your list and we've got everybody you had on it. So, but if anybody can think of anyone else, English as a second language is still down the hall.
Senator Cummings, did you ask the Public Assets Institute?
Yes,
Okay.
they are on the list, and it's a Tina.
Stephanie
Yeah.
Yu, I think, is
You, okay.
who came in. She has some interesting charts.
Yeah, so we've got public assets. And we'll try and get a full view of that. Okay, so we are going back to 161 Rygate. And Chuck Storrow is here. And Chuck, thank you for subbing, and please extend our condolences to Dylan and his family.
I will do that, Madam Chair. Thank you very much.
But we aren't going to pass his bill just because we know he's sorrowing.
Oh, darn.
Okay, Senator Bray, you have a question, statement?
Yeah, no, sorry, my hand's up, but it's not very visible.
It blends in with the brilliant sunshine in your
floating in the curtain there. It's a little dated at this moment, but so I just wanted to support what Senator Brock was saying. Let's get the data and let's look. The COVID sometimes gets presented as a reason to let all sorts of things happen. It could be that it was a boon to a corrugate manufacturer, because that's what I've heard about the corrugate markets with all the shipping that's been going on in the last 2 years, that it's actually a great time to be making corrugate. So, and then the other, I think it was mentioned that Efficiency Vermont was asking us to do this. I think they're actually complying with the law that we passed. And in general, when people aren't part of the traditional Efficiency Vermont program, it's part of I think they are yielding to pressure to let people sort of out of the standard program and the standard measures in order to do something else. So I think they're complying and yielding more than asking. That's all.
Okay, no, they were the ones that suggested that they were meeting with the interested parties and that we let them talk.
Absolutely.
I don't know that they're yielding to anything. They just said, we're talking. Let us finish our talks and we'll come back to you. So, Mr. Storrow, yesterday we had another discussion about Rygate. And I think what I'm hearing from the committee is we really worked on this last year and thought we had an agreement. And this year, we don't seem to be able to reach agreement to extend this out to, essentially 10 years, because we're not sure what's changed in the past year. And the thought was, why don't we give it a year, see if progress is possible? We've got all these theoretical things, but if you actually have a biochar person that's interested, you could come back and say, okay, we've got a company that's interested. This is what they want to do. But a condition of their signing with us is that we have to guarantee them heat, power, whatever, for X number of years. I think we understand that to ask for major capital investment when you never can guarantee anything, but guarantee that their power, heat, one of their major components is going to be in existence 3 or 4 years down the road, then no, you don't make the capital investment. So I think that was it. We wanted to give you a chance to do some feedback on that.
Well, thank you very much, Madam Chair. Chuck Storrow, Leonine Public Affairs for the owners of the Rygate plant, Stored Solar. And certainly appreciate the sentiment that the committee is the direction that you're going. It still creates a conundrum, and this is the conundrum, is that whether it's stored solar or somebody, a third party that they're working with, it's going to take between 10 to $15 million to design, permit, and build a biochar plant, and it'll take about 3 years. So even, to start making that investment, the stored solar needs to know that it has a reasonable shot at getting the current obligation on the part of the utilities to buy the power, which I'm going to refer to as the must-take obligation, extended until 2032. However, by the same token, we fully understand that the committee can't just do that, extend the must-take to 2032, as a blank check and hope that we get something done in terms of biochar or any other type of facility. So what S161 does is that it extends the must-take until 2032, but then it provides in that transition provision that if a plant that utilizes the waste heat and increases its efficiency by an expressed amount is not built and operational by November 2025, then the must-take obligation goes away and it's done. So we basically, it's in our destiny is a little bit more in our control. We will get the extension to 2032, but in order to do that, we actually have to have the plant up and running by November of 2025. And that's something that everybody can see and know happened. There's no argument. Either it is or it isn't. And if it isn't, and if we sit on our hands between now and November 2025, then we go poof.
Okay,
and that's what's reflected in S161 as introduced. Now, Dylan did submit proposed changes that reflect, on the one hand, S190 from 2020, which did extend to 2032 without really any conditions. And these are all these changes that relate to the issues that the utilities and the department raised, like dispatching the plant, meaning basically the must-take doesn't apply when we're at certain times of the year, and we coordinate that to be when the plant's shut down for maintenance, other things like that. We also imbued this sort of 2025 drop dead date with some interim benchmarks to address concern that we do, under our proposal, need an additional guarantee of 1 year of the must-take from the current expiration of November 2024 to extend that to 2025, because we think it'll take 3 years to get the plant built. But we are willing to show that, in July of 2023, that we have a contract to build the plant, and then there's another deadline in there that we have completed the engineering of the components. The biochar facility will actually, good portions of it, of the machinery, will be assembled elsewhere and brought in and then installed. So we want to make sure that the committee and that it's known that we're not going to just get that additional year and then just wash our hands of the matter and not do anything, that we're moving forward. So we're trying to have some certainty that if we get it built and it's operational, then the must-take stays in place under a new rate that would be developed by the PUC, reflecting all of these ratepayer protection provisions. But at the same time, we fully recognize that we can't be given that additional, that 10 years without doing something. And if we don't get it done by November 2025, the must-take is over.
Okay, so right now, we gave you till 2024, right? Yeah, if you met certain conditions. I remember
Actually,
Yeah.
it's just a straight extension
it's
of.
just, and we told you we would like to see you try and get increased efficiency, get another business using your heat or basically your heat.
Right, that's.
So you're saying that if we give you another year, because you don't think, but then the guarantee, all right, so the quid pro quo is, sounds like you're talking to somebody and they're saying it's going to take 3 years to build this thing.
We assume that that this bill, if it were to pass, wouldn't become effective until May.
Right.
And the current must take arrangement expires November of 2024. That's 2 years and 5 months. We're saying that's too tight. We need 3 years and 5 months to get it built. But if we don't get it built by November 2025, we're done.
Okay, so you're asking for an additional year.
We're asking for
you're asking for a year when it's guaranteed, because that's how long your estimates say it's going to take to build whomever you're talking to build. But in order to get them to sign on the bottom line, they need to know that Rygate will be there providing the heat that it's providing until 2032, because they've got X million dollars invested in building this plant.
Right.
And the alternative, I guess, for us is if we do nothing right now, we can all sit there until 2025. And then just let the whole thing shut down. Or
well, if right now the must take goes away in November of 2024, but whether it's November of 2024 or November of 2025, we really can't move forward unless we know we can go to 2032. But on the other hand, we can't just ask you, give us until 2032, and then we all go home and maybe nothing happens. So we're saying give us till 2032, but subject to us getting it built by 2025. And that requires extending the existing arrangement for, well, basically until 2032, but at a minimum until 2025.
2025, which is
if we don't have it
longer than you've got now.
Yeah, and if we don't have it built by then, well, then that we can control whether we get it built. I'm not going to knock on wood when I say we can control whether we get it built by November 2025. We think we can. 3 years and 5 months should be enough.
Okay. Well, I think if you've got a building up and you're just waiting to get an electrician to put in the final wiring, we'd probably understand.
We'll come running back to you in March of 2025. Saying it's 90% done. Give us another year.
Yeah, no one.
That's down the road. We don't know. Yeah.
Supply chain issues, and who knows what will be in short supply in 5 years. Okay, Senator Pearson.
Chuck, at issue here is, at some level, not permission to operate. And we have all talked about the chicken and egg problem of your dilemma. But what we're really talking about is whether we force a subsidy and purchase of the power. And that is not just with a favorable rate, but we already consider it renewable. We already allow, have set up our structure to allow RECs from facilities subject to some kind of scrubbers and whatnot. So, but the electric market is really volatile, and what we're hearing is that, you know, it moves a lot. The rec market moves a lot, and there are people who tell me that having renewable baseload power is really quite valuable. And Green Mountain Power has testified that they're, you know, comfortable buying your power, basically. Others have said it's a little bit, we would otherwise not buy this power. My question is, has the owner been involved in just a direct conversation with Green Mountain Power, take it out of our sphere and figure out a private power purchase deal with them, given that we have put this under a renewable characteristic and allowed it to be, you know, traded with RECs and et cetera? That is that possible? Have people explored that?
You're basically, Senator, saying, why can't we go forth as a merchant plant that, you know, just has to survive in the marketplace? And I'll say, first of all, I don't believe that conversation has occurred with Green Mountain Power. But I am told that without the subsidy, the plant can't operate. And, you know, I would argue that what we're proposing that would lead us to not only increase the efficiency of the plant, but also generate a new revenue stream which will then reduce the amount of subsidy that is needed. So it seems like that's a good way to go. And then I would also, you know, point out that net metered power and standard offer power is also heavily subsidized. I do believe that, you know, Rygate at certain times of the year is very competitive with market rates. The situation, as I understand it, though, is that companies like Green Mountain Power, they have their own generation assets, which includes, you know, part ownership of the McNeil wood chip plant, which is probably a little more costly to them than would be for other sources, but because they own it, they don't need a must-take arrangement. You know, the subsidies for net metered and standard offer power, and given the benefits that the plant presents for the forest products economy, the relatively modest subsidy, not insignificant, but not enormous, is a worthwhile proposition as a matter of policy. The utilities, you know, they have long-term contracts with Hydro-Quebec, with the hydro dams, owners of the hydro dams on the Connecticut River, that do provide power to them at low end, with Seabrook nuclear power. You know, it's lower cost than the 10.1 cents that Rygate gets. So whether they would voluntarily enter into a contract to buy power at a rate that we need to keep operating, I don't know. I heard Mr. Smith from Green Mountain Power say, you know, we're a little more expensive than what they otherwise may be paying, but it isn't too bad. And given the value that we provide, you know, I heard them say, we're not against it. I don't think they're jumping up and down in support of it. So I throw that out there. As far as Washington Electric Co-op wanting to be carved out, first of all, Burlington Electric is carved out because this is all about biomass plants, and they are a majority owner of the McNeil plant. So they're doing their part in terms of biomass. Washington Electric, they have an argument, I would acknowledge, that the subsidy shouldn't be borne by the ratepayers, should be borne by the taxpayers. All I will say is that in principle, I understand that. The reality is That would require an appropriation from state government. That isn't the case that happens with net metered power, which is subsidized by the ratepayers, or standard offer power, which is subsidized by the ratepayers. And, you know, I do work in the healthcare field, and people who pay premiums for individual and small group markets, about a third of that is attributable to the fact that the state underfunds Medicaid. So there's a subsidy going on there. So I'm sort of saying, I get it, WEC, but the reality is this is the way to do it, and they shouldn't be carved out.
So if I could just follow up, I mean, I would say I agree with you to some degree, particularly about larger net metered systems, but Rygate had, as I understand, a pretty generous public investment for construction. So it's a little different, or there's a parallel, and this is an ongoing dynamic. But to the extent that probably we wouldn't be having this conversation if it wasn't for our interest in the timber industry and the challenges that industry has had in the last decade with closing paper mills and stuff. Have you been down the hall? And I don't mean to put my good friend Senator Sorokin on the spot, but we're investing millions of dollars in businesses in the name of jobs and security, and as it relates to the pandemic. Have you explored that straight up? Take this out of the ratepayer discussion and see if there is an interest because of the very straightforward benefit to the forest industry?
Senator, no, we have not. I mean, now that you mentioned that, we will, look into that. And I mean, I think I haven't been following what's been going on in Senate Economic Development and Housing and General Affairs, but I'm taking by implication that there's money available. So we'll certainly look into that. This is the model that's been in place since 2012. I don't know what the history prior to that is, but that's when Section 8009 of Title 30, which imposes the must-take obligation, was enacted. Directed the board, the PUC, to set a rate. They did after a year-long proceeding, and they landed at 10.1 cents per kilowatt hour. So we're not really asking for something that new. We're asking to perpetuate something that's been in place for 10 years now, and not only perpetuate, but we want to improve on the situation by increasing the plant's efficiency and creating a new revenue stream, which will result in purchasing more wood chips. The biochar is going to require more wood to go into that plant. So that's why we're doing what we're doing.
Thanks.
I saw Senator Hardy and then Senator Sorokin.
And
And Senator Bray's little hand.
This reminds me, this conversation now, did we last year get a sort of fiscal note of sorts? Like what is the value of this subsidy? What is the dollar amount that we're subsidizing in total every year?
Senator, I believe it's $4 to $5 million a year.
$4 to $5 million a year, and it's basically paid for by the ratepayers paying higher electric rates.
That's right.
Okay. And yesterday our attorney raised some concerns she had earlier, but she reiterated them yesterday about the way that the language is drafted with the session law.
Yes.
And she would prefer that it be brought into actual statutory law so that it's not, more consistent with how things have been. Did you look at that? And
yes, I listened to and watched yesterday's proceeding. I know exactly what Ellen is talking about. I'll be honest with you. I did a lot of the writing on this bill, and I structured that section 3, bill section 3 as session law. That's the statute says the bill would provide that the must take obligation is extended to 2032, and that would be in the codified statutes. And then this drop dead date, which would make that must take go away by if we don't get the plant built by 2025, that's in session law. It is odd. She has a valid point, because let's say that provision kicks in and the must take obligation is terminated because of that session law. You look at the statute in the green books, it says goes till 2032. That's a little bit of a head scratcher.
Mm-hmm. Yeah.
However, the only parties who are affected by this is Rygate, Vermont Electric Power Producers, Inc., which is the middleman. They pay us and they get the money from the utilities, and they'll know, and the utilities, and they'll know if we didn't get it done. So it is legitimate. There's a sort of an anomaly. Somebody who's totally doesn't have any knowledge about any of this, looking at the green books, would say, they're good till 2032, but we would know we're not. And everybody in the parties who are paying the money would know that we're not. So it is odd. I don't see it as a big issue. I heard Ellen say, well, maybe we put it in the statute and in the green books, this termination provision related to 2025. That's fine.
Okay.
That's her call. That's sort of our thinking on doing it the way we did that, but I recognize what she's saying.
I guess back to my previous point about the subsidy. I mean, part of me wants to I feel like I'm kind of trapped in one of those little hamster balls, and it's really frustrating. And frankly, it's really, and this is not to insult anybody, but it's also really kind of boring. And I really want to get out of the hamster ball. So I just don't want you to come back next year if I happen to be on this committee again and have to listen to it all over again. But you just told us it's $45 to $50 million of ratepayer money. That's a lot of money over 10 years.
10 years. Yes.
Yeah. Still a lot of money. And so I want to make sure that we have the right protections in place and that we're really clear what our goals are. And if our goals are to, help the forest products industry, to, make more renewable energy, I don't know. I just want to make sure that our goals are clear as to why we're spending that $45 to $50 million of Vermonters' money.
That's fair enough. The one thing I would want to point out, Senator, is that under the bill and under our proposal, the PUC would set a new rate. If we meet that, if we get the plant up and running by November 2025, the PUC is obligated to set a new rate for the period 2026 to 2032. And the reason 2026 comes up is that it'll take them a year to set that new rate. The value created by the biochar or whatever facility will be factored into that rate making determination. In other words, it'll be a revenue stream that will have to be taken into account. And all the other factors that the PUC will have to take into account, including, what is the price of power in the world at that time, 2026. So it could well be that the rate will be lower. And this is where solar is potentially jumping off a cliff because, okay, we get the plant up and running. Now we're going to take our chances with a new rate from the PUC. Maybe it won't be so good for us and we'll build up facility. The bottom line under that whole rate making process, however, I got to concede is that the plant has to get enough to be able to stay in operation.
Right.
So, but whether that's 10.1 or 11.1 or 9.1 is TBD. And so it's quite possible that the rate will be lower.
It could be higher too.
It could be higher. It could, but
Means
By the
we
same
need it more.
token, there's some supposedly a shortage of natural gas and curtailment possibilities, and everything's crazy out in Powerland. So it may be a bargain at 10.1. Who knows? So there is some uncertainty there. Yes, it's true that there could well be a continuation of the subsidy at the existing level or even higher, but good chance it could be lower.
Okay.
We do subsidize in the goal of developing the renewable market. The feds and the state have subsidized renewable and still do sources. So we're looking at this, which is really a very small sliver of the renewable energy market that we have subsidized, have asked ratepayers to subsidize for societal goals. The old coal plants were the cheapest out there, and I think I know some of them are still out there, and they're still cheap. So at least we've gotten rid of the ones in New England. I had Senator Sirotkin and then Senator Bray.
So, thank you, Madam Chair. I was going to ask the same question as Senator Hardy about the numbers, and I think, Chuck, I could save you a trip down the hall, because while we have a lot of money, it's restricted in many ways. It's one-time monies, it's ARPA monies, and the floating cap is now around $1 million and $1.5 million. So I don't think it's going to meet your needs. And I don't know if you could qualify, this could qualify under ARPA. I did have one question though on the proposal. Why is it if you're agreeing to that, I guess this whole thing disappears if the plant is not up, or the new construction, I guess, whatever the proposal might be, is not up and running by 2025. Why would we continue with the subsidized rate in the period before 2025 if you don't have a signed contract, like at least a year, that you can bring in as evidence that this is going forward? So it seems to me you've got a trigger date of completion of construction when we'll know well before that if there's going to be any construction.
That's a totally valid point, Senator Sorokin. The revised version of the bill that Dylan submitted provides that we have to submit a signed construction contract by July of 2023, and then I forget the date right off the top of my head, but I think it's November 2024. We have to file a certification that the components have been engineered. So, that will provide some sort of check-in points that show that we're moving forward, and we're not just going to take this extra year of for sure extension of the must take and then sit back on our hands. So we hear you on that, and that's why we designed that. I mean, it isn't in the bill as introduced. It just says the bill is introduced. We have to have it done by November of 2025, but we we've come to learn that there's need for further sort of assurances that we are in fact moving forward. So I would urge you to take a look at what we've submitted in that regard. It does provide.
In other words, you're saying that if the milestones have not been met, then the subsidized rate would stop immediately.
The subsidized rate would stop at the current end date of November 1, 2024.
Okay, thank you.
Okay, Senator Bray.
So this is a bit of a puzzle. I did want to go back to something Mr. Storr was saying about we do have subsidies in the form of standard offer, although that program is ending. We do have in the form of net metering, and those have been reduced. And so I think the the landscape has changed where we keep on looking for clean, renewable power to bring online, but at more competitive rates. And I'd say that this plant is dated enough that I'm not so sure that it competes that well in the current marketplace. As I think maybe Senator Pearson said, probably we wouldn't have this conversation if we weren't concerned about the wood products industry. And
a couple of things that I would just mention on that, Senator. One is that this is base load power, so it's not
Sure.
like wind or solar.
Yep.
And I know that the vision is to have stored, energy storage to overcome the intermittent nature of those wind sources, but that's going to be an expensive proposition too. I don't know, I forget what the exact number is, but I think the power coming from Kingdom Community Wind is costing, it's owned by Green Mountain Power, so it's not like they're buying it, but it's I think 10.1 cents is competitive with Kingdom Community Wind.
Okay, well, right. And so the utilities will have to talk for themselves. I think part of what also complicates the GMP willingness to take the power on is the Rex transfer to them. And that represents a business opportunity in and of itself. So the cost of power is not the total cost that GMP has in order to, when they take this power. That's my understanding. So that, I suppose we should vet it, but
yes, and the Rex would continue to go to the utilities, the buying utilities under that's in the statute and that's not changing.
Sure.
Okay.
The last little thing is that when we last renewed this in an early schedule, it was in order to allow the international company that owned it to have it to make it a more valuable asset for sale. So I feel like we're being asked to engage in supporting various business decisions in a way that feels to me different than how we usually sort of shop for power on behalf of Vermonters through things like rate making.
I acknowledge what you're saying, Senator. It is an unusual situation.
This is a unique plant in a unique place. So, okay, committee, we're going to have to wrap this up. Senator McDonald, I was just about to congratulate you for being restrained. Can I limit it to a question?
No, but I might voluntarily make a short comment.
Okay. Your internet is doing very strange things. You are moving like Charlie Chaplin.
Is anything else?
That's better, little better. Okay.
Okay. This is a unique plant, Madam Chair, and the state of Vermont spent a lot of money in its first 20 years subsidizing an experiment, and the experiment determined that when it came to making electricity, it wasn't profitable, and then we've subsidized it a few more years. Base power has its value. This plant produces base power at a higher rate than you could buy renewable base power elsewhere. And those are just some of the math issues. I appreciate Mr. Stower's testimony. He has sort of laid out the concerns that that company is working on. I'm prepared to listen to more testimony on it and see if there might be an extension for them for another year to provide some, what they're asking for. We took testimony from Green Mountain Power just the other day. They told us that they would be glad to buy 80% of the power that was coming out of Reigate. They thought it was a fine deal for Green Mountain Power. Green Mountain Power said it would increase their costs of electricity by 0.5%. And they were still eager to buy that power. If they bought every bit of the power, it would increase their cost by 0.5%, and they would own it all. That might be a way to, if that option is out there, and rather than having to put it on, make the rural areas that have more expensive power pick up the tab for a plant that it can't earn its own way. So we may be headed to a solution here, and I don't know what that solution is, but let's remember some of the numbers around what we're being asked to do. So thank you, Madam Chair.
Thank you, Senator. But for the record, unless I am told that we have a reasonable solution, I'm not bringing this bill up again, because we have spent 4 or 5 sessions spinning our wheels and saying essentially the same thing. I think we all know what the trade-offs are. We all know what the issues are. The question is, are we going to shut this plant down? I think last year we were told there was 30 some small logging businesses that would probably go out of business. We have not heard yet from ACCD, because they are supposed to be working with Forest and Parks to come up with perhaps an alternative plan for the economy in this area. It's not just jobs, it is an essential part of the economy in an area that isn't doing all that well. So, but I'm some of us have another meeting in 8 minutes, so I'm going to wrap this up. Senator Pearson, I'll take you, and then I'm going to leave it to everybody to kind of talk. And if you can decide that there's a path forward, let me know.
Thank you, Madam Chair. You're good to me. My question is about a path forward. Yesterday, Chuck, the suggestion was floated that maybe we just extend the status quo by 1 year. And my question is, does that help? Is that a better than nothing? Or is that not worth it?
It's certainly better than nothing, but it doesn't set the stage for, the enhancements to the plant that we're talking about. And essentially is the same thing that we're talking about, because if you extend it by 1 year, you're extending it from November 2024 to November 2025. And under our proposal, we're saying we either get it built by 2025, November 2025, and operational, or we're done. So it's giving us another year is the same thing as what essentially we're proposing. It's just that what we're proposing is if we get it done, then subject to a new rate, we go to 2032. But if we don't get it done, then we're done, 1 more year. We've got that 1 more year that the committee's off or tentatively offering to us now. So I'd be honest with you, our proposal is sort of the same thing, but it gives us the ability to do stuff that would then give us a pretty good shot at being able to go to 2032.
Okay, thank you. That's been a lingering question. I appreciate it, Madam Chair.
All right. Now, when you said just continue the status quo, I thought you meant just continue where we are right now, what we did last year. So I think I misunderstood that. Okay. Think, talk, and if we can find a path forward, let me know. But I think we've hashed all the issues out. It's just seeing if we can figure out what we're going to do with them. Okay, thank you, everybody. We will see everyone tomorrow.